Most traders chase price. Professionals study behavior. The one rule that changes everything is this: price means nothing without volume and result. Example, price pushes higher on narrowing spreads and declining volume. Amateurs see strength. The Wyckoff student sees demand failing. When effort increases but result diminishes, the market is speaking. Learn to read that language, and the chart stops deceiving you. I must impress upon you at the outset that price by itself explains nothing. It is merely the final expression of forces already at work beneath the surface. To observe price alone is to read the market's last sentence without understanding the paragraphs that preceded it. The trained operator does not ask, "Where did price go?" He asks, "What caused it to go there?" Every movement in price is the result of a struggle between supply and demand. This struggle is not theoretical, it is visible. Volume is the footprint of that struggle, and spread is the measure of its outcome. When demand exceeds supply, price advances. When supply overwhelms demand, price declines. Price, therefore, is the effect, never the cause. The public is taught to believe that price movement itself creates opportunity. They chase advances and flee declines, assuming that motion equals meaning. This error accounts for the majority of trading losses. Movement without analysis is noise. Meaning is found only when effort and result are compared. Consider an advance that attracts widespread attention. Price pushes higher day after day, and the news appears favorable. To the untrained eye, this is strength. But the Wyckoff student asks a more precise question: is the result proportional to the effort? If volume expands dramatically while price advances only a short distance, demand is being met by supply. Someone is selling into that advance. The cause is distribution, though the effect still appears bullish. Conversely, price may decline sharply on ominous headlines, yet volume contract and spreads narrow. Here, selling pressure is losing effectiveness. Supply is being absorbed. Price is falling, yes, but the cause is drying up. The market is preparing for a change of character. Only those who understand that price is secondary can recognize this opportunity. You must train yourself to think as the composite operator thinks. He does not react to price, he uses it. He marks price down to test supply and marks it up to test demand. These actions are deliberate. Price is his instrument, not his guide. This is why I insist that charts must be read from the inside out. Volume tells you the intensity of professional activity. Spread tells you the degree of success. Price merely records the outcome. When these elements are read together, the market's intentions become clear. Once you accept that price is an effect, your entire approach changes. You stop predicting and start diagnosing. You stop chasing and begin waiting. You no longer ask the market for permission to trade. It tells you when the conditions are right. Master this rule, and confusion gives way to clarity. Ignore it, and price will forever lead you where others want you to go, never where understanding resides. If I were permitted to teach but one analytical principle to the student of the market, it would be this: judge price movement not by appearance, but by the relationship between effort and result. In this comparison lies the market's honesty. Everything else is secondary. Effort is measured by volume, the amount of activity required to move price. Result is measured by spread and progress, the distance price travels and the ease with which it does so. When effort and result are in harmony, the market is healthy. When they diverge, something important is taking place beneath the surface. The public is impressed by activity. Heavy volume is interpreted as strength. Quiet trading is dismissed as insignificant. This misunderstanding leads traders to buy at the very moment when professional interests are selling. Large volume accompanying limited price progress is not bullish, it is evidence of opposition. Demand is meeting supply, and supply is holding its ground. Suppose price advances to a new high on markedly increased volume, yet the spread narrows and closes off the top. The effort is great, but the result is poor. This tells us that selling is absorbing the demand. The composite operator is distributing stock to eager buyers. The public sees excitement. The trained observer sees exhaustion. Now consider the opposite condition. Price declines sharply over several days, but volume diminishes and spreads contract. The selling effort is losing effectiveness. Supply is being withdrawn. The result no longer matches the effort. This is not weakness, it is preparation. The market is being tested to determine whether additional supply remains. It is essential to understand that professional operators leave footprints even when they attempt to remain invisible. They cannot conduct large campaigns without revealing themselves through volume. Their actions distort the normal relationship between effort and result. Your task is to recognize these distortions. Markets do not turn because of opinions, news, or indicators. They turn because the balance between supply and demand has shifted. That shift is visible first through effort and result not through price alone. Price often continues in its prior direction even after the underlying cause has changed. Those who rely solely on price are therefore always late. Effort versus result also teaches patience. A trader who understands this principle does not rush into apparent strength or flee apparent weakness. He waits for confirmation that effort is producing the expected outcome. When it does not, he becomes alert. This alertness is the foundation of professional judgment. You must learn to ask the market simple, direct questions. Is increased activity producing progress? Is reduced activity halting movement? Is the market responding as it should? When the answer is no, the market is signaling a change of character. This principle, properly applied, removes emotion from trading. It replaces hope with observation and prediction with understanding. When effort and result agree, follow the movement. When they disagree, stand aside and study carefully. The market is always truthful, but it speaks quietly. Effort versus result is the language in which it reveals its intention. Learn that language, and the market will no longer surprise you. The stock market does not speak in words, nor does it announce its intentions through headlines or forecasts. It communicates through behavior. Every fluctuation in price and volume is an action, and every action has a purpose. To the casual observer, these movements appear random. To the trained student, they form a language precise, deliberate, and remarkably consistent. I have long maintained that the market is governed by men, not by chance. These men, what I termed the composite operator, must buy and sell in large quantities. Because of this necessity, their operations cannot be hidden. They reveal themselves through tests, hesitations, accelerations, and failures. These are not accidents, they are messages. The public attempts to interpret the market through news. This is a grave error. News follows price, it does not lead it. By the time information becomes widely accepted, professional interests have already acted. If you rely on news, you are studying the market's past. If you study behavior, you are observing its present intentions. Behavior is revealed through recurring actions, rallies that fail to progress, declines that lose momentum, sudden expansions of volume without corresponding price movement, and quiet periods that precede decisive advances. Each of these events is a question posed by the composite operator to the market. Is there supply here? Is demand willing to respond? The market answers immediately, and that answer is visible to those who know how to observe. Consider the test. Price is marked down into a prior area of support. If supply is present, volume will expand and price will fall easily. If supply has been exhausted, volume will diminish and price will refuse to go lower. The market has just spoken. Nothing further is required. Or observe a breakout above resistance. If the move is genuine, demand will follow through and price will advance with ease. If the breakout stalls on heavy volume, the behavior tells you that selling is absorbing demand. The message is not bullish, regardless of appearances. The mistake made by most traders is that they expect certainty. The market offers none. It offers evidence. That evidence is found in behavior, not in indicators, opinions, or predictions. Indicators are merely derivatives of price. They lag the very behavior you must learn to read directly. To read market behavior properly, You must abandon the desire for constant action. Markets spend far more time preparing than advancing. During these periods, the composite operator is active, though price may appear stagnant. The behavior within these ranges tests, springs, failures to follow through is where real understanding is developed. This is why I insist on close study and comparison. One action means little by itself. A series of related actions reveals intent. Markets, like men, must be judged by what they do consistently, not by what they appear to do momentarily. When you learn to interpret behavior, fear diminishes, confusion fades. You are no longer surprised by sudden movements, because you have already seen the preparation. You stop reacting and begin anticipating, not by guessing, but by understanding cause and effect. The market is always speaking. Most simply do not know how to listen. Learn its language, and you will find that it tells you exactly what it intends to do long before the crowd becomes aware. One of the most persistent misconceptions held by the public is the belief that news creates market movement. In reality, news serves only as an explanation, often a convenient one. After professional interests have already completed their work, the market moves first, the news arrives later. This is not coincidence, but design. Large operators cannot wait for public information to act. Their campaigns require time, discretion, and preparation. Accumulation and distribution are conducted quietly, often in periods of uncertainty or discouragement. By the time favorable news appears, these interests are already positioned. What the public perceives as a beginning is frequently the end. Strength and weakness, therefore, must be sought before headlines confirm them. They reveal themselves through price and volume behavior during times when the news is neutral, confusing, or even negative. This is why I advise students to study the market's actions rather than its explanation. Consider a market that refuses to decline despite unfavorable reports. Prices react downward briefly, volume contracts, and selling pressure quickly diminishes. This behavior tells you that supply is no longer effective. Professional buying is absorbing shares. Strength is present, though the public remains pessimistic. Now observe the opposite condition. Prices advance on favorable announcements. Yet volume expands dramatically and progress is limited. Rallies fail to follow through, and reactions grow sharper. Here, weakness is developing even as optimism spreads. Professional interests are distributing stock into public demand. The news is bullish, but the behavior is not. The composite operator understands human psychology. He knows that the public requires justification to act. News provides that justification. It draws in buyers at the top and sellers at the bottom precisely when professionals require liquidity. Thus, news becomes a tool, not a cause. If you wait for confirmation from headlines, you will always be late. By then, the cause has already been built, and price is in the process of reversing. The skilled trader, therefore, learns to distrust obvious explanations and focus instead on subtle signs of change. These signs include narrowing spreads on declines, reduced volume on reactions, inability to make further progress after heavy effort, and repeated tests that fail to break support or resistance. Such behavior signals that the balance of supply and demand is shifting regardless of what is being said publicly. This does not mean that news is irrelevant. It means that its timing is unreliable. News often accompanies the result, not the cause. By the time it becomes widely accepted, its value as information has been exhausted. To trade successfully, you must reverse the public's habit. Instead of asking what happened, ask what was happening before anyone noticed. That is where opportunity lies. When you recognize that strength and weakness appear in advance of news, you cease to be influenced by emotion-driven narratives. You no longer chase excitement or panic. You act only when the market has revealed its condition through behavior. The market prepares in silence and moves in noise. Learn to study the preparation, and you will find yourself aligned with the force that truly move prices long before the crowd is given a reason to believe. I have observed, through many years of market study, that one of the gravest errors committed by traders is the isolation of events. They examine a price movement on a single bar, a single day, or a favor time frame, and attempt to draw conclusions from that fragment alone. This practice leads inevitably to confusion. The market must be read in context, for no action has meaning except in relation to what has preceded it. Time frames are conveniences, not authorities. They divide the market for ease of observation, but they do not change the underlying forces at work. Supply and demand operate continuously, regardless of whether one observes them on a 5-minute chart or a weekly record. To focus on time frame while ignoring context is to mistake the clock for the cause. Context is the market's position within its broader campaign. Is the market emerging from accumulation, advancing in markup, distributing at higher levels, or declining in markdown? Until this question is answered, no signal, however precise, can be acted upon intelligently. A rally has one meaning when it occurs after a prolonged decline and another entirely different meaning when it appears late in an extended advance. A sharp break has vastly different implications when it follows distribution than when it appears within an accumulation range. The public often treats these events as identical. The professional never does. Let me be clear. A sign of strength is not strength unless it appears where strength belongs. Likewise, a sign of weakness is meaningless unless it occurs in a position where weakness is expected. Context supplies this positioning. Without it, traders buy breakouts that are actually distribution and sell breakdowns that are merely tests. The composite operator always works within context. He accumulates areas of discouragement, distributes in zones of optimism, and uses shorter-term movements to serve longer-term objectives. His actions on the smaller scale cannot be understood without reference to the larger design. This is why I instruct students to begin their analysis with the broader structure. Study the range. Identify the boundaries. Observe how price behaves near support and resistance. Note whether reactions are becoming shorter or more severe, whether rallies show increasing ease or growing difficulty. These observations establish context. Only after this groundwork is laid should the trader examine the finer detail. Lower time frames are useful for timing, but never for judgment. Judgment must be formed from the larger picture, where cause is being built. The smaller picture merely reveals how that cause is being expressed. When context is ignored, traders become slaves to signals. They react to every movement, mistaking activity for opportunity. When context is understood, most signals are dismissed as irrelevant. Only those that align with the market's structure or position are acted upon. This understanding brings discipline. It teaches patience. It reduces the number of trades, but increases their quality. You are no longer tempted by every fluctuation, because you know that most fluctuations mean nothing. Remember this, the market is always doing something important, but it is not always ready. Context tells you when preparation is underway and where action is justified. He who masters context sees the market as a complete campaign, not a series of isolated events. And once this perspective is gained, the confusion of conflicting time frames disappears, replaced by clarity, confidence, and control. The desire to predict is the undoing of most market participants. Men are naturally inclined to forecast, to guess what should happen rather than observe what is happening. In the stock market, this tendency is costly. The market does not reward opinions, it rewards alignment. I have always taught that one must wait for confirmation before committing capital, for confirmation is the market's permission to act. Prediction is an act of ego. Confirmation is an act of discipline. The public seeks to anticipate turns, believing that the first position taken will yield the greatest profit. In reality, the earliest entries are often the most dangerous because they are made without evidence that the opposing force has been overcome. Confirmation means that the market has demonstrated its hand. It has shown that supply has failed or that demand has been exhausted. This demonstration occurs through behavior, through price and volume acting in harmony. Until that moment arrives, all conclusions are tentative. Consider accumulation. Many traders attempt to buy the lowest price, assuming that value lies where price has declined the most. But decline alone proves nothing. True opportunity arises only when selling pressure loses its effectiveness, when volume diminishes on reactions, spreads narrow, and price refuses to go lower. The spring, followed by a successful test, is confirmation. Before it, there is only speculation. Likewise, in distribution, the public attempts to sell at the first sign of weakness. Yet markets often continue higher despite early warnings. Confirmation comes when rallies fail to make progress, when reactions deepen, and when demand can no longer lift price. Only then has weakness been proven. The composite operator does not predict, he tests. He marks price down to see if supply remains. He marks it up to determine whether demand will follow. These tests are experiments, and the market's response is the verdict. Once the verdict is clear, action follows swiftly and decisively. This principle protects the trader from emotional involvement. Without confirmation, fear and hope dominate decision-making. With confirmation, action is taken calmly because the market has already validated the premise of the trade. Waiting for confirmation does not mean hesitation or missed opportunity. On the contrary, it places the trader in the position of greatest safety. The largest portion of a move occurs after confirmation, not before it. The aim is not to capture every point, but to participate in the movement that has proven itself. You must also learn that confirmation is contextual. A sign of strength is valid only when it appears in a position where strength is logical. A single signal taken in isolation is insufficient. Confirmation is cumulative. It builds through repeated evidence. When you abandon prediction, you abandon anxiety. You are no longer concerned with being right. You are concerned with being aligned. Losses, when they occur, are accepted as information rather than failure. The market does not ask for your opinion. It offers proof. Wait for that proof. Act only when it appears. In doing so, you place yourself alongside the professional interests, moving with the current rather than against it. This, more than any forecast, is the foundation of consistent success. When these principles are understood together, the market ceases to be a puzzle and becomes a study of cause and effect. Price is no longer followed blindly, but interpreted as the result of professional activity. Effort is weighed against result. Behavior is read instead of headlines. Strength and weakness are recognized before they are announced. Context governs judgment, and confirmation replaces prediction. These are not separate ideas, but parts of a single discipline, the art of aligning oneself with the composite operator. Master this discipline, and you will stop reacting to the market and begin understanding it. From that understanding comes patience, confidence, and consistency. The market has always been honest. It is the observer who must learn to listen.